Hi and welcome to Swissquote's daily market talk. It's Tuesday, April 8th. We are in the middle of the tariff storm. Headlines fly in the air, markets go up and down, and no one really knows what's next. Many hope that the Federal Reserve and maybe the other central banks as well would step in to temper the shock, but others actually warn that the rising inflation makes especially the Fed's maneuver margin quite limited. So yesterday was a hell of a Monday. I'm telling you, the markets were shattered. The European stocks had crazy slides. The DAX index, for example, in Germany was trading down by around 10% lower compared to the Friday's close. The Stoxx 600 index was down by more than 6% at some point in time. The Swiss SMI index lost more than 5% to the close, and it's a big fall, mind you, for the Swiss companies that are mostly focused on consumer staples and pharmaceuticals, for example, and that are normally seen as defensive plays. While the US stock markets actually opened significantly down yesterday, but then suddenly the trend reversed. The major US indices rebounded on rumors that Donald Trump could eventually delay a part of the tariffs that are due to come in play by tomorrow. Now, note that the S&P 500 jumped around 8% just on that particular wave of optimism, then fell again by 5% as the White House came up and said that it was probably a misinterpretation, that was nothing to be considered. Now, finally, the S&P 500 closed yesterday's trading session with a minor 0.23% slide. Nasdaq even eked out a 0.19% gain, but the intraday volatility that we saw yesterday was at levels not seen since the COVID sell-off. The VIX index actually shot up to 60 level yesterday. Yes, we had shortly seen that level during last summer's sell-off when traders actually were closing their carry positions in Japanese yen, remember, and selling their risky assets. But the feeling of the trading room yesterday was a day from COVID. Now, this morning, the futures are in a better shape. We see between 1 to 2% gains across the European and US index futures this morning at the time I'm talking here. But remember that big jumps are as worrying as big sell-offs in terms of panic indicator, because when you see the S&P 500 jump, 8%, you necessarily know that something is not turning round. And something is clearly not turning round, as you probably noticed. Because now we are facing an avalanche of headlines on trade and tariffs, on who is ready to negotiate against US tariffs, who is not, what did Donald Trump say, and what did he mean. And it's very hard to predict what's coming next. There is no more structure in the market anymore. Now, for now, the Europeans actually say that they are willing to negotiate with the US in order to temper the shock, but they also show their teeth and threaten that this could end in tears with 25% tariffs on their American imports, and also strong measures against the US technology giants. China, on the other hand, said that it would retaliate no matter what to the end, and Trump doubled down his threat, saying that he would then impose additional 50% tariffs on Chinese imports, which would take the total tariff for China to above 100%. Japan, on the other hand, will apparently send its officials to discuss, while countries that are more economically vulnerable, like Vietnam, for example, simply give in and say that, they will do something about Donald Trump's demands. And as per the markets, there is little chance that we see the dust settle for good before a clear decision on the tariffs. Now, Senator Elizabeth Warren of the US was just saying on Bloomberg TV this morning that one person started the dumbest trade war in history, and that they should be able to do something about this craziness, as this is not an outside factor like a virus, for example, or people are not necessarily losing their mortgages or their homes. This is something that could actually be controlled by rolling back the tariffs. So let's hope for the best and that reasonable negotiations and decisions moving forward. Now, big investors, big bank bosses in the US and even Elon Musk, the first friend, are criticizing the crazy trade policies of the White House. Maybe, but just maybe, the pressure from inside the United States would make a difference. But I don't know really. No one really knows. Of course, the amplitude of the market sell-off that we see today brings the question of how and when the US Federal Reserve would intervene to stop the bleeding in the financial markets. Now, the problem here is that this time the Fed is probably stuck between a rock and a harder place than during the global financial crisis and the pandemic, for example, because by then we didn't have an inflation problem and the Federal Reserve's balance sheet was, well, much lower than today's. Today, on the other hand, the US inflation that rose during the pandemic times hasn't yet eased toward the Federal Reserve's 2% policy target just yet. Indeed, the core inflation in the US is still sticky around the 3% mark, and the tariffs of such magnitude could only push the prices higher because, one, the imported goods and parts will cost higher for the US producers. Then, two, the manufacturing jobs in the US are costlier than those in China or Southeast Asia. I mean, I hear a rumor that an iPhone could cost up to $3,000 if it was made in the US. So yes, there will be a certain impact on inflation. Then of course the economy will slow due to the supply chain disruptions due to the tariffs. So the Fed is asked to choose between fighting inflation and stabilizing financial markets. Good news is that they have a dual mandate. So I believe that if the market sell-off gets worse, the Fed will have to save the markets first before fighting inflation. As such, and even though the Fed President Jerome Powell said last Friday that the Fed is not in a rush to cut the interest rates in the US, the consensus among investors today is gently moving toward the possibility of 4 interest rate cuts this year from the Fed instead of 2 penciled in before the Liberation Day. But again, bond investors are very, very much confused too as the others, because the possibility of a deal or the possibility of deals or a sudden delay of the tariffs could eventually trigger a market rebound, a risk rebound, and the unwinding of the dovish Federal Reserve expectations could actually cause sharp sell-offs in the bond markets as well. In the sense, we see that the Bank of America's MOVE index that gives you an idea on the bond market volatility is spiking higher as well. But to answer a broad-based worry, well, the sharp moves that we see on the sovereign bond markets do obviously affect the mark-to-market value of a portfolio, but it does not change the fact that the bondholders will receive their full capital at maturity if there is no default. So that makes the bond space a little bit better in terms of long-term risks than equities for the portfolios, but the volatility here as well looks like it is unavoidable as investors try to find their way in the dark. In the FX markets, well, the US dollar index was better a bit at yesterday's trading session on that little optimism, but is under pressure again this morning against majors. The trade worries do have the opposite impact compared to the one that was expected by analysts initially. The euro, for example, is consolidating its gains just below the 110 mark instead of a slide toward parity, and that despite the heavy market sell-off. And some even think that the new world order with an increasingly isolated United States could eventually increase appetite for the euro as a trade and maybe a reserve currency as well. Commodity currencies, on the other hand, are suffering big time, obviously, with the trade tensions. The Aussie dollar in the cents tipped a toe below the 60 cents level at yesterday's trading session. So that was the lowest level since COVID, and it remains under pressure. The Chinese, on the other hand, let the yuan weaken to counter a part of the loss of competitiveness of the Chinese companies due to the US tariffs. The Chinese equities, on the other hand, are better a bit this morning. Now, one hope among investors is that the worst has already been priced in and that the markets could only rebound from the actual levels. But the problem with that optimism is the worst keeps getting worse with no reasonable limit at the White House, and the upside volatility is as bad as downside volatility. So we do not uncork the champagne until we see a sustainable easing in volatility levels. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, but also on our WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will see you again tomorrow. And until then, good day trading.